Welcome, everyone. We are pleased that you have joined us for today's webinar entitled Trust as a Beneficiary of a Qualified Account. This webinar will last approximately 15 minutes, and at the end, you will be given an opportunity to receive supporting materials by email, free of charge to you. You will also be told how you may email questions related to today's content to the presenter. Today's presenter is Linus Suchas. Linus worked for a Chicago-based insurance company in various roles, including Director of Advanced Sales and as Chief Marketing Officer. He ran and sold a successful estate planning law practice. Linus also writes the publication Think About It, founded by life industry guru Steve Leinberg, and regularly speaks at industry events. His new book, Sell Out, The Busy Entrepreneur's Guide to Transferring a Closely Held Business, written together with a CPA and a business broker, is now available on Amazon.com. Linus will draw on his legal, tax, and life insurance background and practical experience for today's webinar. And here he is.
Good morning, good afternoon, wherever you are. Thanks, Jennifer. We're going to talk today about trusts as beneficiaries of an IRA or other qualified accounts, and I'm going to refer to trust as IRA beneficiary. Just understand that it can also be a different kind of qualified account, like a 401k or a 403b plan. We get lots of questions about that kind of circumstance from producers and from producers' family members indirectly, who are trying to get their minds around, what the choices are and how to proceed when trust is the beneficiary of an IRA or other qualified account. And in the 15 minutes or so that we're going to spend on this today, you'll get a short overview. It's a lot, it's fairly complicated. You'll see that during the overview if you've never dealt with this before. If you have dealt with it, you do know it's complicated, and we're going to do our best to give you as much information as possible in 15 minutes. But one of the morals of the story is get help. If you haven't done this before, if you're not familiar with the issues, it's best to get help because the issues can be fairly heavy duty. Now, before we get into the topic or into the meat of today's presentation, let's decide on what it is that we're going to talk about next month. You'll have the opportunity to vote in the poll in just a second. The poll will be open. Your three choices are the most asked questions about Medicaid planning, reconsidering qualified charitable distributions, QCDs, and the third choice is ethical issues with incapacitated clients. So we'll go ahead, and Jennifer, if you can open the poll, we'll go ahead and open that up and let you vote on it. We'll give you about 30 seconds to cast your vote. Please go ahead and do it now. If you haven't voted yet and you want to, please go ahead and do that. All right, let's go ahead and close the poll. Next month's topic will be answering the most asked questions about Medicaid planning. Thank you for voting, and thank you for your input on next month's topic. All right, so let's go ahead and talk about trust as a beneficiary of a qualified account. Let me start with a review of something that we've hit on in the past during these webinars and in other places. Helping your client get the beneficiary designation correct with regard to the financial products that you sell them, including qualified accounts, is one of the most important jobs that you can do. Why do I say that? Well, for many of our clients, the beneficiary designation is going to control more of their liquid wealth at their death than any other thing that they do. Estate planning attorneys spend hours and hours with clients making sure that the words in their testamentary documents are correct. But in my own experience, the amount of time that's spent on the beneficiary designation for qualified accounts, non-qualified annuities, life insurance is minutes at best. And I think that's a mistake for a lot of our clients. Some care needs to be taken there because, as I mentioned, there's probably no other estate planning action that will help the beneficiaries more than to have the correct kind of access to cash wealth in the event of the client's death. And so please help your clients make sure that that's right. In some cases, a trust as beneficiary is going to be the right choice. Let's really briefly talk over some of the things, some of the language, some of the glossary about trusts. So a trust is a written document that has all sorts of rules in it for how its assets are going to be distributed and when. The grantor is usually the person who creates the trust. In a lot of the cases where a trust is the beneficiary of a qualified account, we're going to be talking about a testamentary trust. And so the grantor is the decedent, the person who thinks about the trust language while alive and puts those kinds of words in their last will, and when they're gone, the trust comes into existence. So in a lot of these cases, that's who the grantor is. It's the same person as the decedent. The trustee is the person who's in charge of making sure the trust rules are followed. The trustee acts on behalf of the trust and in the interest of the trust's beneficiaries. The beneficiaries are identified in the trust document, and they're the ones who ultimately receive the fruit of what it is that's in the trust. And when we talk about trust corpus or trust principle, we're talking about the stuff that is inside of the trust. There are all kinds of trusts. There are trusts that can be created today. That kind of trust is usually called a living trust. Mentioned that a testamentary trust is the kind of trust that we're usually talking about when we talk about trust as beneficiary. A revocable living trust is the kind of trust that people usually do to avoid probate. People also create during their lifetimes irrevocable life insurance trusts that are designed to keep the life insurance proceeds from inflating the value of their estate for estate tax purposes. Sometimes we're talking about charitable trusts. All that to say there are all kinds of trusts with all kinds of language. And so when you're dealing with a client who has a trust and perhaps wants to name the trust the beneficiary of a financial product, it's helpful for you to understand exactly what it is that the client has in terms of the trust and what it is intended to do. It'll help you guide them best as to what the right kinds of approaches might be with regard to beneficiary designations. Here are some more other kinds of trusts that that people might have: asset protection, marital, special needs. Yeah, all those things are kinds of trusts. So when is it the right choice to name a trust the beneficiary of a qualified account, or when is it not? It's not so easy to determine. So for those of us who are in the financial services business, if we're dealing with qualified accounts like IRAs, our prejudice is in favor of naming individuals as the beneficiary of the qualified account. And the reason we name individuals is that it maximizes the stretch choices that might be available to the named beneficiaries if they're individuals. And that gives a lot of tax flexibility. However, the tempering thing about that is that our clients aren't always primarily motivated by tax considerations. Sometimes there's other family issues they're trying to solve by naming a trust as the beneficiary. A trust usually gives the family more control, and in those types of cases where control over the beneficiaries after the account owner has died is more important than tax flexibility, it may very well make sense to name a trust the beneficiary of a qualified account. Quick reminder about stretch rules. A surviving spouse who is the beneficiary of a qualified account, such as an IRA, can make the choice to treat the account as her own. That can usually be done either in place or by rollover to the spouse's own IRA. If you have a non-spouse beneficiary, the rules are different. The choices that are available depend on whether or not the account owner was taking RMDs yet or not, or was supposed to be taking RMDs yet or not. In general, the stretch choice, if somebody wants to defer out the income tax result as long as possible, the stretch choice is for the named beneficiary to take distributions based on the named beneficiary's age, beginning with the year after the decedent's death. And so if somebody's trying to maximize their tax flexibility, that's the path the non-spouse beneficiary will usually be on. So what choices do we have when a trust is the beneficiary of a qualified account such as an IRA? Well, it depends on whether the trust is a look-through trust or not. If the trust is not a look-through trust, in general, the account has to be liquidated by the end of the 5th year after the original owner's death, if the original owner was not taking RMDs. And if the original owner was taking RMDs, the trust has to liquidate at least as quickly as if the original owner were still alive. So it's based on the original owner's life expectancy. So those choices aren't great for flexibility. They're not as generous as naming a younger individual beneficiary if the trust is not a look-through trust. Well, what if the trust is a look-through trust? First of all, what is a look-through trust? Well, it's a trust that meets some very specific requirements. First of all, the trust has to be valid under state law. Most of them are. Secondly, the trust must become irrevocable upon the death of the grantor, or it was irrevocable before then. The third thing is that the beneficiaries are real people, and we know who they are by the language of the trust. And then the fourth thing is that the trust can be given to the IRA custodian by October 31st of the year following the date of the grantor's death. If all of those requirements are satisfied, and that's an if, that's not a for sure, but that's an if, then you get to stretch if you want. The trustee gets to stretch if the trustee chooses, based on the age of the oldest beneficiary of the look-through trust. That doesn't mean that the oldest beneficiary of the trust gets all the money. It just means that the oldest beneficiary's life expectancy is used when the trustee decides if and when to take distributions from the inherited IRA. Now, in our experience, there's a lot of confusion about beneficiaries. We're talking about two different kinds of beneficiaries when we talk about trust as beneficiary of an IRA. First of all, we're talking about the IRA beneficiary. And for the purpose of today's discussion, what we mean is the trust itself is the beneficiary of the IRA. And then we have to think about who are the beneficiaries of the trust itself. So it's a separate thing. And there might be, 10 or 12 people who are beneficiaries of the trust. And so a lot of times when we're talking to callers at Advanced Underwriting Consultants, we're having to clarify who's the beneficiary and what kind of beneficiary we're talking about. And so, making sure that in your own minds, you parse out beneficiary of the qualified account and then beneficiary of the trust, and you kind of keep them separate. It helps to understand what's going on. So here's a quick example of a look-through trust. Let's say we've got Dr. Dick Solomon, died in 2018 at age 60. IRA worth $1 million, testamentary trust is the beneficiary. There are 3 kids who are the beneficiaries of the trust. The trust is a look-through trust. It meets the requirements. If all that is true, then the trustee can take distributions from the trust based on Harry's age, because Harry is the oldest beneficiary of the trust. The trustee takes those distributions based on Harry's age. The trust now has the money and can redistribute that money to Tommy, Sally, and Harry based on the words in the trust. Harry doesn't get all the money. It is simply Harry's age that is used to calculate the distribution. So that's how a look-through trust works. There's a second special circumstance where a trust is the beneficiary, where RMD choices may be different. And that is that if the trust is really acting as a conduit for the surviving spouse may have extra choices. In particular, a spousal continuation may be available. Now, when does that happen? Well, if the trust says that surviving spouse has a lot of control over what's in the trust, then if the trust is the beneficiary and the trust takes the inherited IRA money and gives it to the surviving spouse may be able to complete a 60-day rollover to her own IRA, and that would be a valid rollover. There are several private letter rulings from the IRS where the surviving spouse was able to take advantage of this, and they all hinged on, did the surviving spouse have a lot of control over the trust? And if the answer was yes, in the private letter rulings, the surviving spouse was permitted to do a 60-day rollover of the inherited IRA to her own IRA. So that's something that needs to be kept in mind. And it's something where you've got a trust as beneficiary and surviving spouse wants to perform spousal rollover, bears working with the family member accountant to make sure that everybody's on the same page as to whether this technique might be considered. And so one of the takeaways from today's short session is, what's the best way forward? Well, the best way forward where the trust is the beneficiary is to get the family's cleanup attorney, probate or estate planning attorney to be an active part of the conversation. Your clients are almost certainly not familiar with how the stretch rules work and how the trust interacts with that. And so it's easy for them to make a mistake unless they've got somebody who's actively advising them. If you're helping them, that's part of the answer, but making sure their estate planning attorney is also part of the answer can help make sure that that you don't end up with unintended consequences. Most the look-through trust stretch option is available based on the age of the oldest beneficiary of the trust. It may be advisable on the front end where the client's thinking about making a trust the beneficiary to have the client set up separate trusts for each one of their kids. So the kids not only have the ability to get distributions from the trust based on the language, but you may also be able to do separate stretch choices if those trusts are set up as separate beneficiaries on the front end. If there are separate look-through trusts for each one of the kids, they may be able to stretch based on their own ages. Whereas if there's just one trust and multiple kids, they can't stretch based on their own ages. They got to stretch based on the age of the oldest trust beneficiary. It can be hard to deal with trust beneficiaries, family member beneficiaries. Helping make sure that your clients are educated about the process, perhaps using today's information as a help is good. The more that you talk to them, the more people involved in the process to help them understand what's going on, the better it is for them, and probably the better it is for you. One last thing before we close this up and I turn the program back over to Jennifer. Where we also often get asked questions about trust taxation, and the taxation of a trust usually is passed through to the beneficiaries. Usually the trust receives money, for example, from an inherited IRA and passes through that money immediately or almost immediately to the beneficiaries of the trust. Where that happens, it is the beneficiaries of the trust who pay income tax in most cases based on their own income tax rates. It is not the trust itself that pays income tax. Where the trust hangs on to the money, that's where the trust is likely to pay income tax at trust rates. That's a generalization. Things are much more complicated than that, but those are some rules of thumb that might help you as you answer your clients' questions about trust taxation. So finally, what should you take away from today? Trust drafting administration, that's complicated. Stretch rules, particularly where a trust is the beneficiary of a qualified account, they are also complicated. If you put all of that together and you try to make sense of it on behalf of your client, it's almost incomprehensible from a client's perspective. So make sure that you explain as best you can along the way. Make sure your client's other advisors are on the same team and explaining along the way. Communicate as much as you can because clients can easily be overmatched by what it is that they've got in front of them. And if you are a producer with one of our client companies, feel welcome to call us as you try to help sort out in your own mind what choices a client might have and how best to advise them. And so at this point, let me turn the program back over to Jennifer. Jennifer?
Thanks, Lennis. And thanks for joining us today. And join us next month on April 3rd for answering the most asked questions about Medicaid planning. If you would like to receive supporting materials about today's webinar, please feel free to email me at asktheexpert@advancedunderwriting.com. Again, that's asktheexpert@advancedunderwriting.com. You may also email us questions related to today's webinar. Finally, for more information about the services that Advanced Underwriting Consultants offer, including phone consultation and newsletter licensing, feel welcome to contact me at 615-224-1291. Again, that's 615-224-1291. Thanks again, and best wishes for continued success.